if you could give a syndicator right now or aspiring multifamily investor looking to get in, how would you suggest they approach that first deal?
Yeah, there's so much advice that I would love to give. And so, based on my experience, what I would advise is to lay as much groundwork as you can before you're actually under contract and staring down that first deal. Because there's no reason why you can't line up your loan guarantor before you've identified an opportunity, right? By the time you've identified a deal, it's too late to find a loan guarantor. It takes time to build relationships and build trust. And that is really, really valuable because that will allow you to focus on other things, primarily raising equity while you're under contract rather than scrambling for a loan guarantor. So that's one of the things I would have lined up. I would make sure to have your earnest money lined up, your loan guarantor lined up, your property management team lined up, whether you're going to use a third party or partner with a co-sponsor or something like that. You really want to have everything lined up to minimize the amount of variables once under contract.
Love it. So, right now, what asset class and strategy are you primarily using in multifamily?
So today our company is exclusively focused on Dallas and Houston
Mhm.
workforce housing, which we define as deals built in kind of the 80s to the 2000s and are in need of some sort of value add, whether it be improved management, renovations to the interiors to raise rents, and cleaning up deferred maintenance. So that's our bread and butter deal, whether it be, like I said, in Dallas or Houston. And then more recently, we've been also focusing on an affordable housing strategy, which is very unique and interesting, that I like a lot given the current uncertain market conditions, where it may not make sense economically or risk-wise to be buying assets and trying to push rents even further, because affordability is tight. And if we do go into a recession, it's going to just be even harder for residents to be able to afford rental premiums. So I do feel like a defensive strategy where the focus is on preserving affordability rather than pushing rents is really a good fit in today's environment.
Yeah, and I think that has a small component to the current like the package deal you're working on right now, because it's in a program to where there's tax deferred or it's tax exempt for having affordable housing units, a part of the community, right?
That's right. Yeah, and the affordable world is so interesting, and I think we're going to go even further into it as we build our experience. And I think our team is really well suited for the affordable housing world because it is more complicated, it's more nuanced. But it takes time to build relationships. But once you kind of get into the affordable housing space, you see people once they get in, they never leave, and they make a lot of money. It's a very lucrative space. So we want to only grow our experience. There's so many different programs to be familiar with, and it's different in every market. So it's a fascinating space. And like I said, I think our team is well suited just given our expertise. My business partner is a tax attorney. We're quite sophisticated. So I think we are well suited for it.
Okay, and is that the primary way you're looking to mitigate risk going forward, or is there some other things you're looking to do?
Well, generally speaking, we are focused, at least for now, exclusively on long-term fixed rate debt, which is really, in my opinion, the best way to mitigate risk. Uh, there is some controversy surrounding that strategy because a lot of people are calling for using floating rate debt today to hopefully benefit from rates drifting lower in the future, which I don't disagree that that's definitely a viable strategy, but the certainty of your cash flow is just worth so much, even if in the end you end up paying a little more interest for that certainty because of the timing with which you lock your interest rate, right? You're going to, over the cycle, you might have a fixed interest rate at a higher rate and then other deals at a lower rate. It'll all work out over time if you're just consistently investing for the long term.
And is that fixed over a 5 or 10 year period, or are you fixing for longer? Because there's like for those that don't know, in single family fixed rate, you sell, I mean, 30-year fixed and you sell in 5 years, no big deal. You get a payoff quote. Typically, unless it's a like a non-QM type loan, if it's conventional, there's really no fees to that typically. But in commercial, different ball game. Like you said, you want a 30-year fixed, they're going to hold you to that, and there's going to be a lot of penalties and defeasance and whatnot. So, how are you baking that into the pie? And yeah, kind of walk me through that.
Yeah. So right now, the strategy is to do 7-year loans with a 5-year yield maintenance period.
Okay.
And that gives us, in our opinion, the optimal long-term conservative loan coupled with flexibility.
Yeah. So if you have to sell, if an opportunity to sell sooner works out, it's not that big of a hit. But if you need to hold on, you've got the surety of what your debt cost is.
Right. And the full 7 years is quite a long time to ride out a potential downturn or something like that. And then, given the 5-year yield maintenance, if we sell in 5 years, which is our typical pro forma, we would pay no penalty to exit, which is really nice.